Listed private equity was not immune from the turbulence across global markets last year. The Barwon Global Listed Private Equity Fund declined over 20% for the year as valuations for all risk assets declined. Unlisted private equity NAVs declined about 5 to 10% for the year. So broadly, companies continue to trade well with good revenue growth. However, the mammoth stimulus response from governments and central banks in response to COVID-19 switched to focus on reining in inflation, which led to a very risk-off market. The higher interest rates and restrictive policies drove down valuation for all asset classes. We think the risk-off driven market decline is overdone, particularly as the more restrictive policies, in our view, have started to take effect at the back end of last year. Shares of listed private equity stocks fell more than the underlying NAVs, leading to a significant widening of discounts to levels not seen for many years prior to 2020. We're only 2 months into the year, but encouragingly, the fund is off to a strong start, rebounding about 10%. Most companies have reported end of 2022 results. Revenue growth remains strong, with many businesses passing on some of their inflationary pressures to customers. Earnings growth, though, is noticeably slower, but it does remain positive. We're already seeing a slowdown in fundraising for the large alternative asset managers. Borrowing costs are also much higher, which puts cash flows under pressure, particularly for heavily indebted borrowers. So overall, the market remains fairly cautious. In saying that caution means that a lot of bad news is already being priced in. As I was saying earlier, we saw a big divergence in performance between unlisted versus listed private equity assets over the last year. The discounts in listed private equity are back at 2011 and 2012 levels, back when markets were still recovering from the GFC. In part, this is the market saying we don't believe the private valuations. But encouragingly, we're still seeing exits from our underlying PE portfolio at 20 to 40% above their prevailing private valuation, which really serves to validate the NAV. The large declines in public market companies compared to private equity-owned companies has caused private equity managers to focus their high levels of dry powder on taking over publicly traded businesses, which have seen far greater declines in valuation. They're also focused on sectors with visible secular growth, such as healthcare, life sciences, travel and leisure, and areas within technology, as a way to offset broader inflationary pressures. And finally, PE sponsors can simply hold on to investments for longer, and we're already starting to see this. They typically execute more add-on acquisitions for existing portfolio companies, and this is a well-worn playbook for well-capitalized, high-quality private equity-owned companies. They can acquire direct competitors, carve-outs from larger corporates, or complementary businesses to expand into adjacent markets. According to PitchBook, add-on activity accounted for a record 78% of all US private equity M&A in 2022, and we think this trend is likely to continue. And those are the areas that private equity managers are deploying their capital today.